Chapter 12 Share-Based Payment Part 1 Overview on the topic or discussion on share-based payment is subdivided into the following chapter. Chapter 12 Share-Based Payment Part 1, which is our topic, Equity Settled Share-Based Payment Transaction, and Chapter 13 Share-Based Payment Part 2 will be discussed by the next reporter, Cash Settled Share-Based Payment Transaction. Learning objectives. First, define a share-based payment transactions. 2. State the accounting methods applicable to share-based payment transaction with A. Non-employees, B. Employees. Last is account for share-based compensation plans. Introduction. A corporation may issue its own shares in exchange for non-cash consideration, such as non-cash assets or services. However, the Corporation Code of the Philippines prohibits the issuance of shares in exchange for promissory notes or future services, meaning the consideration must be received first. If in the form of services, the services must have been rendered first before shares are issued. Furthermore, the value of the consideration received must not be less than the par value or issued value of the shares. Transactions involving the issuance of shares in exchange for non-cash consideration are accounted for under PFRS 2. Share-based payment transaction is a transaction in which the entity acquires goods or services and pays for them by issuing its own equity instruments. A share-based payment transaction can be 1. Equity-settled share-based payment transaction, one in which the entity receives goods or services and pays for them by issuing its shares of stocks or share options. Or 2. Cash-settled share-based payment transaction, one in which the entities receive goods or services and incurs an obligation to pay cash at an amount that is based on the fair value of its own equity instruments. Or 3. Choice between equity-settled and cash-settled, one in which the entity receives goods or services and either the entity or the counterparty is given a choice of settlement in the form of equity instrument or cash based on the fair value of the equity instruments. Equity instrument is a contract that evidences a residual interest in the assets of an entity after deducting all of its liabilities. PFRS 2 applies to all entities including subsidiaries using their parents or fellow subsidiaries' equity instrument as consideration for goods or services, and to all share-based payment arrangement except the following: A. Transaction with owners, including employees who are also shareholders, acting in their capacity as owners; issuance of dividends, granting of stock rights in relation to an owner's prevented right, and treasury share transaction. B. Business combinations, PFRS 2 business combination. C. Issuance of shares as settle of forward contracts, futures, and other derivative instruments, PAS 32 and PFRS 9 financial instruments. Recognition. Goods or services acquired in share-based payment transactions are recognized when the goods are received or as the services are received. Goods or services received that do not qualify as assets are recognized as expenses. The entity recognizes A. A corresponding increase in equity if the goods or services are received in an equity-settled share-based payment transaction, or B. A liability if the goods or services are acquired in cash settled share-based payment transaction. Next, equity-settled share-based payment transactions. Goods or services received from equity-settled share-based payment transactions with non-employees are measured at the fair value of the goods or services received, or if this is not determinable, at the fair value of the equity instruments granted. For transactions with employees and other providing similar services, the fair value of the services received is often not possible to estimate reliably. Accordingly, PFRS 2 requires those services to be measured at the fair value of the equity instruments granted, or this is not determinable, at the intrinsic value of the entity. T. Shares of stocks. Equity-settled share-based payment transaction with non-employees, employees, and others providing similar services. In non-employees, order of the priority measurement: 1. Fair value of goods or services received. 2. Fair value of equity instruments granted. On the next side, employees and others providing similar services. Order of priority in measurement. 1. Fair value of equity instruments granted. 2. Intrinsic value. So, employees and others providing similar services refer to individuals who render personal services to the entity, and either A. The individuals are regarded as employees for legal or tax purposes. B. The individuals work for the entity under its direction in the same way as the individuals who are regarded as employees for legal or tax purposes. Or C. The services rendered are similar to those rendered by employees. Equity instrument granted is the right or conditional or unconditional to an equity instrument of the entity conferred arrangement. Fair value is the measured at the same measurement date. A. For transaction with non-employees, the measurement date is a date when the entity received the goods or services. B. For transaction with employees and others providing similar services, the measurement date is the grant date. Grant date is a date at which the entity and the counterparty agree to and have shared understanding of the terms and conditions of a share-based payment arrangement. If the agreement is subject to further approval by shareholders, grant date is a date when that approval is obtained. Intrinsic value. Intrinsic value is a difference between the fair value of the shares which the counterparty has the right to subscribe or receive and the subscription price, if any, that the counterparty is required to pay for its property. A share option with fair value of 50 peso and an exercise price of 30 peso has an intrinsic value of 20 peso, 50 pesos minus 30 pesos. Illustration 1. Measurement date. Transaction with non-employee. On January 1, 20X1, ABC Co. agreed to issue 10,000 shares with par value per share of 100 peso to XYZ Incorporation. In exchange for a building was completed prior to year-end, ownership over the newly constructed building was transferred to ABC Co. on December 31, 20X1, but a contract price was settled on January 31, 20X2. ABC Co. uses the cost model for its property, plant, and equipment. The fair values of the newly constructed building were 1,500,000 on December 31, 20X1 and 1,600,000 on January 31, 20X2. The quoted prices of ABC's share were 110 pesos on December 31, 20X1 and 120 pesos on January 31, 20X2. Requirement: provide journal entries on December 31, 20X1 and January 31, 20X2. So as you can see, this is the solution. January 1, 20X1, no entry. December 31, 20X1, building. This is 1,500,000, guys. And subscribe capital 10,000 times 100 peso is 1 million. Share premium 500,000. In January 31, 20X2, subscribe capital 1 million. And share capital is also 1 million. Notes: the building is measured at its fair value, not the fair value of the shares, because the transaction is with a non-employee. 2 is the fair value used is the fair value and measurement date. For transactions with non-employees, the measurement date is a date when the entity receives the goods or service. In the illustration above, the measurement date is December 31, 20X1. The date ownership was transferred. Third, no adjustment is made on the value of the building on January 31, 20X1 because ABC uses the cost model. Last, after measurement date, no adjustment are made for amounts recognized in equity. Variation: fair value of asset received not determinable if the fair value of the building cannot be determined reliably. The transaction will be measured at the fair value of equity instruments granted. The journal entries will be as follows. So, January 1, 20X1, no entry. December 31, 20X1, building 10,000 times 110 peso. So, 1,100,000. And then subscribe capital 10,000 times 100 pesos is 1 million. Share premium 100,000. January 31, 20x2, subscribe capital 1 million and share capital 1 million. Illustration 2, measurement date, transaction with employees. On February 1, 20x1, ABC Co. offered its key employee share options that enable them to acquire ABC shares for 80 peso. The shares are selling at 120 peso on February 5, 20x1. The key employees counter offered an exercise price of 70 peso, which was accepted by the board on February 6, 20x1. The share options were approved by the shareholders on a general meeting on April 1, 20x1. The key employees received the share options on May 1, 20x1 and are to be exercised on before December 31, 20x1. Question: at which date should the fair value of the options be valued for purposes of PFRS 2? So here is the answer. April 1, 20x1 for transactions with employees and others providing similar services. The equity instruments granted are measured on grant date. The grant date is the date at which all the parties involved have shared understanding of the terms and conditions of the arrangement and such understanding has received the necessary approval. Illustration 3, Share Issued Services. On January 1, 20x1, ABC Co. contracted Miss Sexy Model to be the endorser of ABC's new product. ABC shall issue 10 million shares with par value per share of 10 peso in consideration for the services received. All of the required services on the contract have been rendered on March 1, 20x1. Information on fair values is shown below. Fair values, modeling services, January 1, 20x1 and March 1, 20x1, 950,000 and 1 million, and then 90 per share, 98 per share. Miss Model is not an employee. January 1, 20x1, no entry. March 1, 20x1, advertising expense 10,000. Share capital 10,000 times 10 par 100,000. Share premium 900,000. Notes: the service is measured at the date when it was received, March 1, 20x1, because the counterparty is a non-employee. Next, shares are issued only after the counterparty renders a service. Last, if goods or services are received on more than one date, they shall be measured at their fair value on each date they are received. Next model is Miss Model is an employee of ABC. So she is an employee of ABC. Miss Model is a secretary of ABC's president. January 1, 20x1, no entry. March 1, 20x1, advertising expense 10,000 times 90 peso FU, 900,000. Share capital 10,000 times 10 par is 100,000, and share premium 800,000. The service is measured at the fair value of the shares granted at grant date, January 1, 20x1, because the counterparty is an employee. Share-based compensation plans is arrangement whereby in exchange for services, an employee is compensated in the form of or based on the entity's equity instrument. Examples of share-based compensations are A. Employee share options, equity settled. B. Employee share appreciation rights or cash settled. And last, C. Compensation plans with a choice of settlements between A and B. Share-based compensation are given to key employees as bonuses or additional compensation. The benefits of a share-based compensation to the employer may include a possible reduction in employee turnover because employees will have to remain in the entities employed during the service period in order to exercise the equity instrument granted. Employees will also be more motivated in contributing to the achievement of the entity's goals because they are given an opportunity to become owners of the entity. Employee share option plans is a contract that gives the holder the right, but not the obligation to subscribe to the entity shares at a fixed or determinable price for a specified period of time. Some share options given to employees do not require any subscription price, meaning the shares will be issued solely in exchange for employee services. Measurement of compensation. Employee share option plans are equity settled share-based payment transaction with employees. Accordingly, the services received are measured using the following order or priority. 1. Fair value of equity instruments granted at the grant date. 2. Intrinsic value. The compensation expense, salaries expense on the employee share option plan is recognized as follows. 1. If the share options granted vest immediately, meaning the employee is entitled to the shares without the need to satisfy any condition. Salaries expense is recognized in full with a corresponding increase in equity at grant date. Vesting period is the period during which all specified vesting conditions of a share-based payment arrangement are to be satisfied. In the absence of evidence to the contrary, it is presumed that share options vest immediately. Vesting condition. Vesting condition is a condition that determines whether the entity exhibits the services that entitle the counterparty to receive cash, other assets, or equity instrument of the entity under a share-based payment arrangement. A vesting condition is either a service condition or a performance condition. A service condition, a condition that requires the employee to render service over a specified period of time in order to be entitled to receive or subscribe to the shares embodied in the share options. B. Performance condition, a condition that requires 1. The employee to render service over a specified period of time, service condition. 2. Specified performance targets to be met while the employee is rendering that required service. Examples of performance targets: first, achieving a specified growth in profit. Next, attainment of a specified increase in the entity share price. So, vesting condition can classified as a market condition, a performance condition that is related to the price of the entity share, attainment of a specified increase in the entity's share price. And B. Non-market condition, a condition other than a market condition, service condition achieving is a specified growth in profit. Market conditions are taken into account when estimating the fair value of the shares or share options at measurement date. Fair value estimates are not be subsequently received irrespective of the outcome. Accordingly, compensation expense is nonetheless recognized for the service that the employee has rendered even if the market condition is not satisfied and the share option do not vest. Next, non-market conditions are taken into account when estimating the number of equity instruments that are expected to vest. The estimate is subsequently revised in light of new information. Changes in estimates are accounted for prospectively, meaning the compensation expenses recognized in previous years are not restated. Types of conditions. Example, non-attainment of vesting condition. So, non-market condition, example is remaining in employ. And the non-attainment of vesting condition is discontinue recognizing further compensation expense for the employee who resigned. The next market condition, example, increase in share price. And ignored, continue to recognize compensation expense for the equity instrument granted. Compensation expenses that have already been recognized are not subsequently adjusted regardless of the outcome of either a market or non-market condition. The related share premium that has already been recognized remains in equity. Only a transfer within equity may be made from share premium, share options outstanding to share premium. So, illustration 1, changes in service condition. On January 1, 20X1, Entity A grants 100 share options to each of its 100K employees conditional upon each employee remaining on Entity A's employ over the next 3 years. The fair value of each share option is 15 pesos. On the basis of a weighted average probability, Entity A estimates in January 1, 20x1 that about 20 employees, 20% or 20 out of the 100 employees will leave during the 3-year period of therefore forfeit their rights to the share options. During 20x1, 7 employees left. Entity A revises its estimate to a total of 25% employee departure over the vesting period. During 20x2, 9 employees left. Entity A revises its estimate to a total of 28% employee departure over the vesting period. During 20x3, 8 employees left. Therefore, the actual employee departure over the past 3 years is 24%. 7 plus 9 plus 8 divided by 100. So, Entity A recognizes salaries expense over the vesting period as follows. So, as you can see in the table, date January 1, 20x1, O entry, December 31, 20x1, 10,000 A times 75% B, and times 15 times 1/3. So salaries expense is 37,500, and then December 31, 20x2, 10,000 times 72% times 15 times 2/3 minus 37,500. Salary expense 34,500. December 31, 20x3, 10,000 times 76% times 15 times 3/3 minus 37,500 minus 34,500. Salary expense 42,000. A 100 employees times 100 share options granted, and B 100% minus 25% estimate of total employee departure equals 75%. Notes: the initial estimate of 20% on January 1, 20x1 is ignored because salaries expense are recognized at year end. Next is on the vesting date, December 31, 20x3, the actual employee departures are used in computing for salaries expense. The total salary expense recognized over the vesting period equals the grant date fair value of the share options that have actually vested. This amount is only allocated over the vesting period. Analyze the reconciliation below. 10,000 times 76% equals 7,600 share options that have actually vested. 15 peso equals 114,000. Total salary expense 37,500 plus 34,500 plus 42,000 equals 114,000 total salary expense. So, January 1, 20x1 memo entry, December 31, 20x1 salary expense, share options is 37,500 and share premium options outstanding 37,500. December 31, 20x2 salary expense, share options 34,500 and share premium option outstanding 34,500. December 31, 20x3 salary expense, share options 42,000, share premium options outstanding 42,000. Modifications of terms and conditions is accounted for only if it is beneficial to the employee. A modification is beneficial to the employee if A. the total fair value of the equity instruments granted is increased, or B. the vesting period is shortened. If the modification increased the total fair value of the equity instruments granted, the incremental fair value is recognized as additional expense over the remaining vested period. If the modification shortened the vesting period, any remaining amount of salaries expense not yet recognized is recognized over the remaining shortened vesting period. A modification that is not beneficial to the employee, a decrease in the total fair value of equity instruments granted, or lengthening of the vesting period is not accounted for. Cancellation and early settlement are accounted for as acceleration of vesting. The amount of salary expense that would otherwise be recognized over the remaining vesting period is simply recognized immediately. Any payment made to the employee on the cancellation or settlement of a grant is accounted for repurchase of any equity interest as deduction from equity, except if the payment exceeds the fair value of the equity instruments measured at the repurchase date, in which case the excess is recognized as an expense. If the grant includes a liability component, the liability component is remeasured first and the payment for the liability component is accounted for as an extinguishment of the liability. And that's all for my report. Thank you.